What does IP monetization really mean?
Monetization is a crude word. It focuses only on money. Money's the output. Money's not the input. The input is helping brands and helping businesses delight their fans and bring them closer to the fans, and that's what we do.
Are there 3 to 5 clauses that make a partnership great?
If you have to rely on 3 to 5 clauses to make the partnership great, you don't have a great partnership.
I've heard you say before, and this is an amazing quote, starve your losers and feed your winners.
It's very simple. If something's not working, more money typically isn't going to make it work.
I'm curious how you run your annual budgeting process.
Focus on the infinite, which is revenue, okay, versus the finite, which is expenses. I and every other CFO, I'm sure, loves to cut costs and loves to drive efficiency, but I will always focus on the infinite versus the finite.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to Run the Numbers, the show where we talk with the world's top CFOs and finance leaders. I'm CJ, a tech CFO, and my goal is to unpack the frameworks and operating principles that make you better at allocating capital and leading teams. On today's show, I'm speaking with Glenn Schiffman, courtesy of our mutual friends at the New York Stock Exchange. Glenn is the CFO of Fanatics, the global digital sports platform that sits at the center of sports commerce. They span merchandise, collectibles, and sports betting. 10-year-old CJ is going nuts right now. Before joining Fanatics, Glenn spent more than 2 decades in investment banking, including a long stint at Lehman Brothers. He also was the CFO of IAC, the people behind Match.com, where he helped oversee one of the most prolific capital allocation engines in tech and media. In this episode, we go deep on the economics of sports IP, how Glenn thinks about CAC, LTV, and capital allocation across the business's various verticals, and negotiation lessons from Glenn's decades as a deal maker. I would not want to negotiate against Glenn. If you like this show, please remember to like and subscribe. It helps us with the algorithmic overlords. And if you're looking to hire the best finance and accounting talent, I would love to help you. I run a recruiting service that pairs you with thoughtful, qualified candidates from a warm community of finance leaders, the type of people who just love net dollar retention. If that's of interest, shoot me an email at talent@mostlymetrics.com and we will talk. On to today's episode with Glenn. Glenn, thank you so much for joining me on the podcast today.
CJ, good to see you. Thanks for having me.
So you played football at Duke back in the day. Do you remember who made the jerseys back then?
So I got my Duke helmet behind me. It's not, of course, the one I used, but yes, I did play football at Duke. I'm a big supporter, but I have no idea who made those jerseys. And it was a different day back then. It was 1987, which ages me, of course, my freshman year. Gosh, we didn't even get any swag. I mean, the kids these days, the players these days, they get, the game used jerseys. They get all of the gear, which, of course, Fanatics makes in our partnership with Nike for about 25 colleges, including Duke, actually.
Oh, you got the Duke contract. That's amazing. I love it.
We do through our partnership with Nike.
You also do Alabama and another whole host of high-powered schools.
Yeah, our college business is multifaceted. For some colleges, we actually manufacture the fan gear, the jerseys in partnership with Nike that the fans wear, the warm-up gear, the sideline gear. With other colleges, we, in our partnership with Barnes & Noble and Lids, manage the bookstore and the merch that's sold in the bookstore. We own the Champion brand for branded sports merchandise, so sell a lot of the Champion gear. Probably your first college sweatshirt was a Champion. They got that great reverse weave, thick Champion patented feel. So we do that. We power the websites for probably 65% of the Power 4. It used to be the Power 5, it's now the Power 4, but we power the websites, which means it's University of Alabama sports, a Fanatics experience. So again, it's a multifaceted relationship, and we'll talk about this, I'm sure, throughout the podcast, all to bring the fans closer to the teams, the athletes, and the sports they love.
That's incredible. Well, while we're on the topic of colleges, this is a CFO podcast, but man, you've got an entrepreneurial streak to you as well. Do I have it right that you owned a number of businesses in college?
I did. I actually took a pay cut my senior year to come and work on Wall Street, given how well we were doing back in the day.
Break it down for me. What type of businesses were these?
So I owned two businesses in partnership with others, and then founded two businesses. So the two businesses I owned, don't laugh, you're going to laugh. One was a bar. It was a bar on campus. And the way we structured it was someone had owned it and a group of students bought it. And then we kept handing it down in generations. So when you graduate, you sold it to someone else. So that was a lot of fun. I owned Duke's Guide to Durham. It was a Blue Pages. Think about a curated Yellow Pages. So in the spring, we go out selling ads. And then the summer, we made it. And then the fall, in the 95 degrees plus, we'd deliver, the books to every person on the dorm. And then I founded two businesses. Actually, it was the predecessor. I should have patented this, and then I would have been successful. The predecessor to DoorDash. It was something called Student Delivery Systems. I went to the university and I said, hey, can this person, this off-campus food provider, use the point system? So it was the first time in America that off-campus food could go on campus and you could use your meal plan. And so I got the concession to run the delivery, and that was good. As that got rolling, I said, there's something to this. So graduated 3.5 years, did a joint venture with that company. We created a new company, Intercollegiate Food Systems, where we're going to do this concept throughout the country. And in fact, we got on about 6 or 7 campuses with this concept. As the summer came, we had some trouble getting financing A and B. All my friends were going to Wall Street and going to New York, and the siren call of Wall Street and the siren call of New York kind of pulled me. I ended up selling the business back to my partner, and all those businesses I ended up selling. It was a good 6-month, 12-month run that my senior year, where again I took a pay cut to come to Wall Street.
There's a through line here because your career and all the businesses you've worked in, they deal with negotiations and partnerships. And I'm excited to talk to you today because it goes all the way back to your college stint as an entrepreneur where you were brokering these joint ventures and partnerships. And today at Fanatics, you help partners monetize their IP and brands. This may be a silly question, but from a CFO seat, what does IP monetization really mean?
Every business wants their brands to be pervasive, right? Every business wants their brands to be a household name. Every business wants their brands to be a 365-day experience, as I said, multifaceted. And we help them. Monetization is a cruel word, right? A crude word. It focuses only on money. Money's the output. Money's not the input. The input is helping brands and helping businesses delight their fans and bring them closer to the fans. And that's what we do. If we delight our fans, we delight our partners. If we delight our partners, we delight our shareholders. But it's always in that order. It comes with the fans first, then our partners, and then our shareholders.
I like how you framed it as monetization as the output of a successful partnership because it feels like you're really selling much more. You're selling a virtual storefront. You're selling a supply chain. You're selling a verticalized way of doing business. Do I have that right?
It's all but again, like we have 1,000 different partners at Fanatics. Unfortunately for our accounting team, they're all snowflakes. They're all different. And I guess our legal team as well, unfortunately for our legal team. They're all different because they're tailored to, the needs of our partners. They're respectful of the nuances of what's going on in their business. So yes, we have a big in-venue retail business. So we're in well over 100 establishments inside stadiums. We run their in-venue store. Some of the stuff in that store is some of the stuff we make. So in our commerce business, we manufacture 50% of what we sell in general. And then we also have a big e-commerce D2C business. You go on fanatics.com or, 900 different partner sites, and you could, again, buy our gear or you could buy someone else's gear. So yeah, our partnerships are multifaceted. And then again, we have a big trading cards business where we service the hobby shops. We service, the big retailers, and we service our customers in a D2C. So yes, it's a big business. Yes, it's multifaceted. It's all the above.
You mentioned that a lot of these deals are snowflakes, so I don't want to generalize here. But from an economic standpoint as a CFO, are there 3 to 5 clauses that make a partnership great?
If you have to rely on 3 to 5 clauses to make the partnership great, you don't have a great partnership. Once the partnership is signed and once you're in business, boy, it's a bad day if you refer back to that agreement.
Spoken like somebody who's been through a number of negotiations that have been successful, but also when you have to clean up something after the fact. I like that.
When you open up that agreement after the fact, what were we thinking? Why did we agree to that? Or why did they agree to that? And was that intended, or was that a drafting error? Or when you open up that agreement, it's usually the start of bad news, not good news.
As a first-time CFO, I actually made that mistake once where I actually sent back the contract to the person and said, that's actually not what it says in here. And he said, like, hey, that's kind of like a BS thing to do. You're getting this debate off on the wrong foot by trying to say, look at these legal terms. So that definitely resonates with me.
Yeah, for sure.
Glenn, you've got a successful partnership that's ripping. Let's say it's with my New England Patriots. I've been buying a lot of stuff outside of Gillette Stadium. What are the KPIs that you look to say, wow, this relationship is great? And I know everybody wants revenue, but from an e-commerce standpoint, is it looked at as how many SKUs are passing a certain threshold, or what do you look at?
It depends on your business objective at the time. And by the way, thank you for your business, and please continue. We have a new Fanatics app, which is really an exciting thing for our fans. So you have free-to-play games on it. You have obviously on-ramps into our shopping experience, and you get more fan cash if you download our app. So I'd appreciate if you and your listeners buy all the stuff through our app, and then I don't have to pay Google or Meta or chase you around the internet and pay someone to get you on our platform. So please download the app next time you purchase your favorite, Patriots gear. Getting back to your question on KPIs. Yes, look, revenue and profitability are the great equalizer. More important than profitability is free cash flow. Like, free cash flow doesn't lie. Cash doesn't lie. So the most important thing, from a CFO's perspective, is the cash, is the free cash flow. But yes, there are top of the funnel metrics that you look at. Number of users, number of new users, right? Because you can only sell so much to you, CJ. Hopefully we could sell a lot. And hopefully you're one of our best customers. But at some point, you run out of closet space or wallet share. One of the things that I watch is top of the funnel is net new people to file, net new users. That's an important one for sure. And then transactions for sure, average order value for sure. One of the things we're focused on now is reducing the discounting and making the discounting more impactful to the individual, aka having higher end merchandise. So I should be wearing at work like a Duke hoodie, and you should be wearing a Patriots hoodie. And some of our merchandise is, super high end that you'd be proud to and desirous of wearing them to the office or wearing them on a podcast. So that's something we track is AOV and discounting attached there. We, of course, track our margins. And then we have a whole heap of operational metrics to make sure we're serving the fan better and better. And there we've done a really nice job over the last couple of years of making the experience on Fanatics just better. The site's more cleaned up. The site's clear. Our time to porch is coming down. Our perfect order rate is going up. How many time customer service contacts going down? So, those are the raw metrics that power and come before the financials. So yes, it's cash at the end of the day, but there's 100 things before cash that we monitor some of the things I just articulated.
Hey, thanks for listening. We'll be right back after a word from our sponsors. If you're paying for A-level finance talent, they shouldn't be doing B-level tasks. CFO time is expensive. Senior finance hires are wicked expensive. And yet, in many companies, highly paid operators still spend hours reviewing expenses, chasing receipts, and reconciling systems that should already be automated. That's where Brex comes in. Brex is an intelligent finance platform that combines corporate cards with built-in expense management and AI agents that automate the repetitive work finance teams usually handle manually. Transactions are categorized automatically. Receipts are matched. Policies are enforced in real time. Reconciliation just runs in the background. So instead of adding admin as you grow, you increase output per finance hire. Brex is already automating hundreds of thousands of hours of manual finance work every month across 35,000 companies, including Anthropic, Coinbase, and DoorDash. If you want your finance team focused on performance instead of paperwork, check out brex.com/metrics. That is brex.com/metrics. I've seen a lot of FP&A tools, and Aleph is one of the few that gave me that aha moment within minutes. I remember watching their founder, shout out to Albert, connect my NetSuite data and build me a full P&L live in minutes. Aleph is now trusted by hundreds of leading companies. I've had the CFOs from Turo, 8 Sleep, Zapier, and more on the pod, and every one of them is a huge advocate. I also just published my second annual CFO Tech Stack report, and Aleph has been on the podium both years, including a #1 finish in the $50 to $100 million segment this year. Instead of being just another planning tool, they built a real enterprise-grade data foundation for finance, implemented at startup speed with AI-native workflows woven into its DNA. All your systems, ERP, CRM, HRIS, ATS, product usage, and more, powering one clean, governed data layer that finance can actually trust. And with AI moving as fast as it is, they're pushing even further. MCP, custom AI chatbots, AI-powered variance analysis, and the list keeps growing. Try it with your own data at getaleph.com/run. That is GETALEPH.com/run. Tell them CJ sent you. So here's a pattern I keep running into when I talk to finance leaders at fast-growing companies. You've outgrown the spreadsheets. You've probably outgrown your billing tools built in RevRec, but you're not quite at the point where you can throw a 20-person team at the problem either. That's exactly the danger zone RightRev owns. RightRev is revenue recognition done right. It handles the messy stuff like high-volume subscriptions, usage-based contracts, and mid-contract upgrades. The things that break your ERP and the billing platform bolt-ons. Here's the thing though, your sales team isn't slowing down for you. They're closing ramp deals, usage commitments, and mid-quarter upgrades. And the longer you wait to fix the engine, the further behind you fall. So stop scrambling at month end and stitching together allocations across 3, 4, 5 spreadsheets to just have the numbers right. Well, that's it. That's the whole pitch. CFOs tell me it's like a glow up for the revenue books. That sounds like where you are right now. RightRev is worth the look. Head to rightrev.com/CJ. That's rightrev.com/CJ. Check them out. Man, things like time to porch and perfect orders, that's the type of stuff that people come to this podcast for, because those are the input metrics that if you want to figure out what's the leading indicator of how well this is going to turn into cash, those are the things that someone like Glenn is looking at.
That's exactly right.
Okay, so buy, bet, collect. I heard you say that before. How do you think about customer acquisition cost and lifetime value across those different monetization moments? Because you could have the same person. I'm sure you want the same person engaging across all three.
We've spent a lot of time and invested significantly on a single view of the fan, and that ain't easy. Some of the purchasers don't log in. So how do we find who they are? So we've invested a lot of money in the ability, the infrastructure, cleaning up our data, deduping our data, and understanding our data. That's a hard lift, and that's a condition precedent to what I'm about to talk about. And you don't see that anywhere on the P&L but for expenses. And expenses, by and large, people don't love expenses. So like we've had the courage, a ton of companies have had the courage to make these hard investments here. One of the reasons we have is because, I think I talked earlier about fan cash, our currency of sport, where you can earn and burn that fan cash throughout our platform. So if you go into some in-venue retail establishments that we run, you can earn and burn it. You can burn it in our lid stores. You can burn it on our sites and our 900 partner sites. You can earn and burn it betting. You can earn and burning in our collectibles business. So that's a critical component of, driving that cross-platform LTV. So getting back to your question, our LTV differs by business. Gaming, it tends to be a little higher. What we find is our multi-business customers, so customers that buy, bet, and collect with us, tend to spend 4.7 times as a single business customer. They repeat more, 1.5 to 2 times. They engage more, and then therefore their lifetime value is significantly more. That multiplies, but the CAC is arithmetic. We are working on, and AI has been a help to this, on finding the next best offer for our customers, understanding, because all behind this, the data that I talked about, we have over 100 million people in our database with billions of attributes. So we know your family size by and large, being your gifting and purchasing behavior. We know when you purchase. We know what emails attract you, what emails don't. We know your patterns. We know, what your fandom is. Knowing all that, harnessing the data, AI is helping us with that. Our fan cash is helping us with that. So we're trying to create the ecosystem where, again, with a stable, maybe slightly increasing CAC, we have arithmetic CAC and multiplying LTV.
Do you think about one of those business units as top of the funnel for the other two, or can you enter from any point?
Well, it's a great, great question. The answer is yes. You can enter from all sorts of different spaces. By and large, though, our commerce business is our biggest business, over 20 million customers a year. There's trading card buyers who come into the funnel, and then we can cross sell them across, and a lot of people in our gaming business. In terms of a new engine of growth, because collectibles was a new engine of growth we built on the back of our commerce business, and but Fanatics Betting and Gaming, we built on the back of our commerce business. We have a new engine of growth coming, which is super exciting. And I think you'll like this as a Patriots fan. We're going to launch a credit card, a Fanatics credit card. So we think this could have real interesting top of the funnel implications for us in terms of getting net new people to the file and a new go-to-market motion. So we're super excited about that. And one of the things we're playing around with, if you pick the 4 champions, NHL, NBA, NFL, and MLB, we'll pay your credit card bill for a year, subject to, of course, a slight cap to make sure we don't blow up the balance sheet. But that will be super fun. So think about the energy in the world that happens in March Madness when everyone's trying to pick a perfect bracket. We'll get that energy every year.
Glenn, you mentioned that AI is making it easier to dedupe the data, to homogenize the data, and to meet customers where they want to transact. And I think it was brilliant the way you explained it, because I heard an analog to Amazon where you may go to Amazon when you're moving from one house to another and you order cardboard boxes and those really annoying styrofoam things that the kids get everywhere from those boxes. Now, Amazon then says, based on other purchasing patterns, we also think that you want to buy a smoke alarm. And that's just because it's looking at the SKUs and it's matching up what other SKUs people buy, but it has no idea that this person is moving. So what's interesting is AI can now get the full story of the intent behind some of these actions, I think, rather than just saying, hey, the next likely SKU in this deterministic function or probabilistic forecast is this one here. So there's something to be said about how your business can better meet fans where they want to transact. And maybe it's around a compelling event like a sports game.
You said it well. We are using AI to help us dissect the data, understand the data. Technology is moving fast. Corporate America is embracing it. Every day there's another aha moment around technology. And look, there's always a sloping up and to the right in technology. Now the slope is vertical in terms of how fast technology is changing. And yeah, we're harnessing it obviously to help us on the expense line and get efficient. And more exciting stuff is on the revenue line, making our products better, making our go-to-market motion cleaner and more efficient and more attractive.
On go-to-market motions, you have a direct-to-consumer collectibles business versus the core commerce business. How does that sales motion show up differently on the P&L, Glenn?
We have a D2C business in commerce and collectibles. We have a wholesale business in commerce and collectibles. And we have a retail business as well. The margin profile is different. The expenses associated therewith are different. By and large, we want to meet the customers where they are. And if they go into a Dick's store, great. We'll sell them one of our exclusive jerseys in the Dick's Sporting Goods store. It's a great partner of ours. If they want to go on our site, wonderful. We'll sell them, the jersey that we exclusively make in our partnership with Nike on our fanatics.com. If they want to go on nflshop.com/Dallas Cowboys, a Fanatics experience, and want to buy it, great. We'll sell them that same jersey. So we just want to go where the fans are, and the P&L follows. And again, there's different margin structures in our wholesale business. Obviously, we deliver it to one person, to Dick's, to our partners, and then they have marketing, obviously, and they have their own expense line to get you in the store and to get you out of the store with the merch.
I'm curious how you run your annual budgeting process, and you can correct me, maybe it's quarterly more so than annual, but that must take a lot of work and foresight with those different line items and margin profiles to get the most out of each of these, while also taking advantage of the wonderful shared resources that you have as a company.
We could do a 7-hour podcast on that if you'd like. No, I wouldn't like that. So let's not do that. Yeah, it's an evolved process. Our business is a little more predictable than most. Our contracts are very long-term with our league partners and our team partners and our players association and our player partners, because the longer term those contracts are, the more we can invest in the fan experience and more we can invest against the outcomes that we and our partners want. So that creates a predictability in our business. That's one. Two, in our business, sports, is also, while the results are unpredictable, I know there's going to be a Super Bowl MVP every year, right? I know there's going to be a Super Bowl winner every year. So that gives us a certain predictability and a baseline of recurring revenue. Also, a lot of sports fans are diehard sports fans. So, 2/3 revenue in my commerce business, greater than 2/3, is from repeat visitors. From you who bought last year, and you know what you're going to do this year? You're going to buy again because you're going to be excited about the Patriots run. So that gives us a little bit of a predictability. So look, we give a lot of autonomy to the businesses. They start on the budgeting process. We want them to control all their inputs to be successful, right? And there are certain shared services and there are certain things that the corporate function, which by and large I run, provide for the businesses. That helps efficiency, of course, and that helps, that Fanatics cross-platform thesis of, the next best offer to the fan. But I will always focus on the infinite, which is revenue, okay, versus the finite, which is expenses. Right? Like I can't cut my way to revenue growth. Okay. So I will always push, revenue growth, which is infinite. I and every other CFO, I'm sure, loves to cut costs and loves to drive efficiency. And we will, and we do, but I will always focus on the infinite versus the finite.
So well said. Hey, thanks for listening. We'll be right back after a word from our sponsors. Being a CFO, you know how much I love tools that actually make the lives of accounting and finance folks easier. One of my favorite tools right now is Rillet, the AI native ERP going head to head with NetSuite. Yes, someone is finally doing it. I met Rillet 2 years ago when they were still in stealth. Since then, they've absolutely taken the finance world by storm. Their mission is to make the zero-day close a reality, and they're actually doing it. Customers are literally closing their books at 1:35 p.m. on the first day of the month. They've got everything you need to scale your business: complex revenue recognition, native integrations, custom reporting, multi-entity, close management, and much more. They're only a few years in and are already supporting NASDAQ publicly listed companies. Yes, seriously. If you want to scale your business on an ERP that wasn't built in the 90s, you need to check out Rillet. Book a demo at rillet.com/CJ. Oh, cool, that's me. That's RILLET.com/CJ. RILLET.com/CJ. Tell them I sent you there. Scaling a tech company is thrilling. It's also really, really messy. Just ask anyone who's done it, or anyone who's tried. Better yet, ask EY. They've seen startups at their best, and in their most fragile moments. EY knows you don't start a company to burn cycles on regulatory hoops, discounted cash flows, or the fine print of SEC Form S1. Although you probably do know I love myself a good S1 if you've listened to or read my stuff long enough. You can't ignore these things. That's how risk compounds. Kind of like negative interest. What you can do is work with EY from day one. They'll help you get it right early and often, so you can stay in builder mode and keep the trains running on time. EY. Shape the future with confidence. Learn more at ey.com/techstartups. That is ey.com/techstartups. Let me ask you something. If your board wants financials, would you be certain you're not wasting money on SaaS? Or if a major renewal hits, would you know if you're paying a fair price? Your vendors would see thousands of deals per year, but most finance and procurement teams see one deal at a time. That's a tough way to negotiate. SpendHound fixes that intelligence gap. It's one place to track all your software spend and gives you pricing benchmarks across more than 10,000 SaaS and AI vendors. And it's based on real spend data from over 8,000 companies. SpendHound connects to your financial systems and shows every software dollar you're spending. Contracts, renewal dates, overlapping tools. Nothing quietly auto-renews, and you don't pay twice for duplicate tools. SpendHound is the #1 rated SaaS spend management platform on G2. It's trusted by teams at ZoomInfo, Hootsuite, and Kit. Free forever, wow, for SMB and only $10,000 per year for enterprise with $150,000 savings guaranteed. If you want to stop negotiating blind, go to spendhound.com. That is spendhound.com, trusted by over 1,000 finance ops and procurement teams. I've heard you say before, and this is an amazing quote, starve your losers and feed your winners. Can you break that one down for me?
It's very simple. Like, if something's not working, more money typically isn't going to make it work. The reason why you starve it is because they got to figure something out. That business or that division or, that opportunity needs to figure it out. You have something wrong. So typically money is not going to solve your problem, because it gets back to that conversation we had earlier on the leading indicators, right? So like, if you're losing money, that's okay. If those leading indicators, right, the KPIs we talked about earlier, if those KPIs are working, and then that's how you determine if they're winning. And if they're winning in the KPIs and the raw metrics that underlie and drive the financial performance, then you feed that. You invest in those KPIs. But if they're losing, yeah, you starve them and you force them to figure it out. There's probably one business we had at Fanatics that, we funded. It just wasn't working. We starved it for resources. They couldn't figure out unit economics that made any sense. And we ended up, cutting off the capital and ultimately selling it. Luckily, the tax structure in this country allows you to deduct those losses because they're expenses, and expenses offset revenue. So the government was our partner and said loss, as it is in all expenses. So it softens the blow a little bit. And then look, we like to invest capital. With that capital, we get increasing returns. And that's what we need by feeding our winners. Okay, like you invest in the stock market, right? Or wherever you invest your personal money, and all your listeners invest their personal money. Like, things that give you good returns and you have the prospect of more returns with more capital, sign me up, right? That's where every stock you buy, every investment you make is in desire of, in furtherance of, investing more money and getting more capital back, increasing returns. So that's the way we think about it in our business. Our gaming business, we have made and are making a significant investment in that business because we're seeing the returns. We're almost doubling marketing this year, okay? Because we're seeing those returns and it's winning. So we're feeding those winners. In collectibles, we've made a bunch of acquisitions, because we're seeing the capital that we can put into acquisitions, moving our returns nicely up and to the right. You want to invest where that more capital gets increasing returns. It's the holy grail of investing.
It sounds like you're looking for capital to compound over time. It's not like you're searching for a linear or a seasonal bet on something. You're trying to make it compound.
That is the magic of finance. Yes, your revenue grows. Given the magic of scale, your EBITDA grows faster, okay? And given the magic of more efficient use of that capital, free cash flow grows even faster. That's how we try and, think about our Fanatics P&L. Revenue will grow, well north of double digits. EBITDA will grow even faster. Free cash flow will go even faster. And then that's only half the capital allocation. Then you have to think about your balance sheet. And your balance sheet, if you manage that intelligently, with, the appropriate use of debt, the appropriate timing of issuing equity, the appropriate timing of buying back stock, you could actually amplify your shareholders' returns, and amplify the returns that are started to be generated by your operators. So your operators drive the financial performance, and then the CFO, the board, the CEO should help manage a balance sheet that accelerates that operating returns to get the even better financial returns for the shareholders.
I'm so glad you brought that up, because at IAC, Glenn, you bought back more than half your shares. What signals told you buybacks were the best risk-adjusted bet?
I don't think it was actually half, but we did a lot. We did a lot. We looked at the stock for a long time was undervalued. We had a big M&A team that looked at buying businesses, and I think in my 5 years, we had about over 50 transactions in 5 years, acquisitions, investments, and whatnot. So we were active and wanted to, buy businesses that we could scale and grow. But at the same time, we looked at our share price and we thought on a risk-adjusted basis, the best returns to our shareholders were buying back stock. And by the way, there's no acquisition risk in that. By and large, you have an informational advantage. You don't necessarily have to do diligence on your own business. Every acquisition you make, there's surprises, because in acquisitions, there's an information asymmetry. The seller has all the information, the buyer has none. Due diligence doesn't tend to, it tries to narrow that gap and narrow that information asymmetry, but it doesn't always do it. But when you buy your own stock back, it's an asset well. There's no integration risk. There's no M&A risk. And, you have a point of view on your business. At Fanatics, we're also buying back some stock at good prices when we can, given, our free cash flow position. It's an important part. Again, as we talked about, 5 minutes ago or so, the working of the balance sheet is as important as the working of the business. Now, again, you can't work your balance sheet when you have a bad business. So you need the good business, and the business is more, the ultimate results, drive it. But you have to be thinking about your balance sheet, working your balance sheet as aggressively as your operating results. And at IC, we did that, and we had a hell of a run.
Would it be fair to say that finance leaders, when they start out, they work their P&L, right? They work the operations to get the most out of it, but you have to mature in your role to be really good at working the balance sheet, to also incorporate the cap table into that capital allocation strategy?
It depends on the person. Like I was a first-time CFO in 2016 at IAC. They took some risk on me. I was a banker. I'm forever grateful for that. Given I was a banker, I probably approached it more with a capital lens, a M&A lens, and a financial engineering lens. I went the opposite way. So I started there, and then I learned the operations. And we had some great people, at IAC who taught me a lot. Some of which have left IAC and subsequently come over to work at Fanatics with me. So I was kind of the reverse. So, but it just depends on your career journey. So the financial capital raise, the IR, the financial engineering aspect of the business kind of came second nature to me because, I was a banker starting.
So like you said, you spent 25 years as an investment banker. You did a ton of deals, billions of dollars of deals. But I want to go back to the very first one that you negotiated on your own at Lehman Brothers. Do you remember that deal?
I remember it like it was yesterday. 1995, we were selling a cable company, Salmon's Communications. It turned out to be a $1.8 billion deal. We tried to sell it as one. It got broken into two. We finally decided to split the assets in two. We had a handshake on the deal. And then we're going to the lawyer's office. Back then, you actually negotiated in person. It was great. Now, it's all this Zoom crap and this emailing stuff. We actually went to a conference room. So I walk into my managing director's office. She was my mentor, wonderful, wonderful lady. And I was like, all right, I just ordered a car. Let's go. She said, I'm going to dinner. I got plans. You're doing it. Good luck. Don't bleep it up. So it was me and the general counsel from the company. And it was a consortium on the other side. So they had bankers and private equity folks. And there were two of us against like 15 of them. And, we had a fun night.
There's a lesson in this deal, too, about how long you kind of dribbled out the clock, isn't there?
You've heard me tell this story. So basically, I was a second-year associate at the time, whatever. I was 95, what was I, 26, 27 years old. We worked hard back then, and people work hard now. But that night, I was pulling an all-nighter anyway. So I was either going to be in this conference room negotiating this deal, or I was pulling back to the office and working on a spreadsheet and pulling an all-nighter. So I said to the general counsel, this is the other side. It was the CEO of the business and all the other stuff. I'm not sure they can outlast us, and I can guarantee you they won't outlast me. We had a little competition, going, which is always helpful in negotiations. So they were pretty anxious. So I was like, what was his name? John. I think his name was John. I was like, John, all right, just let's let's just listen and keep saying, I'm not sure, I don't know. And literally we spent the whole entire night. And when like 8 o'clock or 9 o'clock came by and they ordered pizza and they made it like a thing, then I knew we got them. Because like then they were in my territory, not in their territory. So we just we just squeezed them all night long and just, oh shucks, I don't know, that doesn't make sense, and we're able to increase the purchase price, a fair amount, just understanding the dynamics, understanding the motivations. Deals tend to not age well, so you kind of want to get them done. I knew if we were agreeing at 8 p.m. or 8 a.m., 8 a.m. would have been the better outcome for our shareholders. And we had some fun that night.
There's a kernel of truth in there about knowing who you're dealing with in any negotiation.
And knowing their motivations, are they the decision makers? What truly do they care about? The old joke, you have 2 ears and you have 1 mouth. The counterparty will tell you how they want to negotiate. You just got to listen, ask questions and listen.
Glenn, I'm going to take you into what we call our long ass lightning round. So the first question I ask to every successful CFO who comes on the show is, give me an example of something you've screwed up on the job before. It could be here or any previous role.
I mean, this gets back to what I said earlier. We could spend 7 hours on a podcast doing that. Just recently, the other day, we were talking to and having a negotiation with a partner, and it was a small deal for us. Afterwards, they thought I truly didn't give a crap about their project and their deal. And even though it was a small deal, it's a critical partner to us. So I screwed that up. I didn't pay enough respect. I didn't pay enough attention. I didn't lean into it as much as that partner wanted. Got some feedback, and then I had to clean it up, tell that partner that, we're all in, because that was something that was important to them. And I didn't listen enough. I didn't perceive enough. I didn't understand enough how important that was to them. So they viewed me as too cavalier, and I was. But the first thing, once I heard that feedback, I stalked him on the phone and made it right.
That's such great advice, because you never know how big of a deal it is to the other party, and you have to appreciate that. And that's something I've messed up in my career too, Glenn, where I was like, oh, this is only our 20th biggest partner. I'm like, they're spending 50% of their marketing budget with you. Like, you have to recognize that. Next one I got for you. If you could tell your younger self something knowing what you know today, what would you tell them?
One, take more risk. The way I was brought up or whatever reason, financially, career-wise, I probably didn't take as much risk as I would suggest someone else taking. I was a little more conservative, again, with how I managed my money and my career. That would be one. And then 2, more aggressively network. I've been so fortunate to have worked with so many people, have so many relationships. When you work at an investment bank, you have so many incredible clients. A lot of those clients have become friends, and I probably didn't work the networking thing as well as I should have. So those are 2 pieces of advice I'd give to anyone who cares to listen to me.
Do you tell your kids to take more risks?
I do, but again, like sometimes they listen, sometimes they don't. But again, the person's got to be comfortable. Now, look, they have a easier time taking risks, given, the success that, that I've enjoyed. They could take more liberties.
Next one is more of a technical one. Can you walk me through your finance software stack? What tools does your team lean on to get the job done?
Boy, that's the most boring question anyone has ever asked anyone on the history of a podcast. I guess it's relevant to your users. So we did a big Oracle transformation on Oracle Fusion. So this has, been uphill both ways, barefoot walking on broken glass in terms of, this implementation. We did it on HR, on ERP, EPM, all of ERP, EPM, HCM. Yeah, so all facets of the business, multi-year, ton of money, ton of time. But we now have the entire company on one HR stack, one financial software stack, and the ERP is continuing. We're kind of, the worst is behind us. So that's been kind of the big project. And now, we have a lot of point solutions. The system of record is Oracle Fusion.
What's the craziest thing you've ever had someone try to expense?
I don't know.
Even investment banking days, can't think of something that came across your
I
desk?
don't think I approved expenses in an investment bank. I think it went through the bureaucracy. At Fanatics, I only approve, Michael's, the CEO's expenses. So no, we're mature adults. I don't know if I've seen anything crazy. One of my partners at Lehman, he had this great memo that he framed and put on his wall. There's like this $5,000 expense that was being rejected because he was 1 penny or 2 pennies over, some, per diem or something. So that was always a funny thing when I walked in his office, that, he violated the expense policy by 1 penny or 2 pennies. So they rejected the entire, 5,000 expense.
Glenn, this has been an absolute blast. Thanks for coming on the podcast.
You bet, CJ. Great seeing you. And hopefully we'll run into each other soon.
Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.